Let's be honest, European dividend growth stocks get overlooked. That's exactly why we cover them on Dividend Talk. Here are 5 that have been raising or maintaining their dividend for over a decade, including one that hasn't stopped in 40 years. First up is Novartis, a Swiss pharmaceutical giant that is one of the largest healthcare companies in the world. They sit on European DJI's Noble 30 index as they have 29 consecutive years of dividend increases. The latest dividend increase was 5.7%, bringing the dividend to €3.70 Swiss francs per share, which gives them a yield of around 3% at current prices. The 5-year dividend growth is running at just under 6% per year, which is not bad. The business itself is in good shape. Novartis has been sharpening its focus on innovation medicines since spinning off Sandoz. The balance sheet looks solid and free cash flow comfortably supports the dividend. However, for European investors, Switzerland applies a 35% withholding tax on dividends at source. That is one of the highest rates in the world. And if you're Irish like me, or in most European companies, you're entitled to a reduced rate of 15% under relevant tax treaties. It's a process, but if you don't do it, you're technically leaving 20% of every dividend on the table permanently. Number 2 is Schneider Electric. This one I hold a small position in personally, so I'll be upfront about that. It's Paris listed, and in my view, it's one of the most well-positioned industrial companies in Europe right now. Schneider has grown its dividend for 16 consecutive years, and the final year 25 dividend came in at €4.20 per share. That's an 8% increase year over year. However, the dividend yield is modest and sits currently at around 1.7%. The business is one I've covered before on this channel, but Schneider is effectively the picks and shovels play on AI infrastructure. Revenue in 2025 came in at 40.2 billion, free cash flow was around 4.6 billion, and the order backlog grew 18% year over year. Now, the backlog is your forward visibility on earnings, and by extension of that, the dividend. Now, number 3 is Liquide. Again, Paris listed, and it is a world leader in industrial and medical gases. It is also one of the longest running dividend growth stories on any European exchange. The 2025 dividend was €3.70 per share, which was a 12% increase year over year. The 5-year average growth rate is around 10%, and the 10-year average growth rate is just under 8%. Dividend yield sits at around 2.2% at current prices, which might be low in isolation, but when the dividend is growing at 10%, you're buying it for the dividend growth and not its current yield. One of the cool things about Liquide is that it has a loyalty bonus. If you hold your shares in registered form for more than 2 full calendar years, you're entitled to a 10% top-up on your dividend. Now, this would certainly appeal to any long-term investors. The business itself is defensively positioned as industrial and medical gases are not discretionary spending. Hospitals need oxygen and semiconductors need specialty gases. And luckily, both the electronics and the healthcare segments are growing. And finally, with such a strong dividend growth record, the company has shown a real track record of generating free cash flow through every economic cycle. Now, it was only a matter of time before we got to some insurance stocks. Number 4 on the list is Allianz. Now, Allianz is one of Germany's largest insurers, and it's also one of the biggest financial services companies in the world. Now, this one has not cut its dividend in 17 consecutive years. The 2025 dividend was €17.10 per share, which was an 11% increase year over year. The 5-year dividend growth is running at around 12% per year, and the dividend yield is approximately 4.8% at current prices. This makes it one of the highest yielding on today's list. Now, Allianz runs a 60% payout ratio policy anchored to net income. This gives the dividend a transparent and sustainable foundation. The business spans property and casualty insurance, life insurance, and asset management through PIMCO and Allianz Global Investors. Their diversification across geographies and business lines make it genuinely defensive, and it is the kind of company that keeps paying and growing its dividend through downturns because the business itself is structured to do so. And finally, we have Munich Re, and it's probably the biggest growth story on this list. Now, Munich Re have been paying dividends for over 2 decades. And for context, the dividend has gone from €9.25 per share in 2019 to €20 per share in 2024. And they have just proposed €24 per share dividend for the full year of 2025. That's nearly a tripling of the dividend in 6 years. The yield at current prices sit around 3.6%. Now, we covered Munich Re on the Dividend Talk podcast way back in 2020 when the numbers looked a little bit different, but the investment case has only strengthened since. The company has just reported a record profit of over $6 billion for 2025, and they've launched a new plan targeting around an 18% return on equity by 2030. And what's more is they're also committing to returning more than 80% of its net income to shareholders through dividends and buybacks. Now, Munich Re's balance sheet looks rock solid, the solvency ratio is well above regulatory requirements, and the growing demand for catastrophic coverage is in their favour. So there are your 5 rock-solid European companies. Now, none of these are investment advice, but they are companies worth knowing if you're building a European dividend portfolio and you want companies that have demonstrated a commitment to returning cash to shareholders over time. Do your own research, understand the withholding tax implications for your situation, and make sure that each position fits your broader strategy. However, if you want to see our research, then we cover European dividend stocks regularly on our Dividend Talk newsletter. The link is in the description. But until then, we'll see you next time.